Welcome to Magnet Minutes. This is Jordan Kimmel with an update for May 25th, 2022. And it's with absolute pleasure we bring back on Sam Stovall. Everybody knows Sam. He's the Chief Investment Officer of CFRA. Formerly, maybe we call it S&P, but it's CFRA. And Sam, thanks so much for joining us.
Hey, happy to talk to you again, Jordan.
All right. Well, Sam, it's great to have you. And again, both as a market historian, as a seasonal tactical investor, and whether we are in uncharted territories right now, Sam, or if it's another history rhyming and not repeating, I'm really looking for your insights.
Okay, well, I guess that's basically saying go to it, Sam. In many ways, I do think that history is repeating. What I might have said last time we were speaking was that whenever we have had an advance of 20% or more in one calendar year, we always fell into a decline in the next year. Average decline was in the low teens, but the good thing is that whenever the decline started in the first quarter, we ended up getting back to break even before the year was out. That we only have 20 observations, so a statistician might say that that's not statistically significant, and always one of those times could fail. So, the real question is, do we get back to break even from this current sell-off and then dive down as we head toward recession, possibly in 2023? Or does the recession actually occur sooner than most people are anticipating?
Right. Well, Sam, so look, I think that as a quant myself, I look at the facts rather than try to guess things out, but I also look at the sentiment. And the only time in my career everyone was bullish was the end of 1999. This is probably the most pessimistic. The news is terrible. The international news, the nonsense coming out of Washington is terrible. And so a lot of cash has probably already gone to the sidelines. Valuations have really become compressed simply because of price declines. And I believe a lot of the pure speculation has been just grinded out through price behavior. So, is it too much baked into this negativity, or sometimes you really do see a storm coming and everyone says, well, it's not going to be that bad, I'll ride it out. And then you get a Katrina and you wish you actually had boarded up the windows.
Well, I think that while it is obviously interesting to point to sentiment, point to volatility, et cetera, in many ways, I sort of feel as if those are coincident indicators. It's not like Pierce Brosnan, who is seeing increased seismic activity before Dante's Peak below its top. Usually we see volatility ending up being coincident. Through the end of April, we actually recorded 2.5 times the number of 1% moves on a daily basis in the S&P versus the average for the first 4 months for every year going back to World War II. But the thing is that this volatility is likely to be increasing as we head toward possibly a capitulation bottom. A lot of the technicians that I speak with say, no, we really probably have not hit the bottom because we have not had the flushing out, the shaking off of the loose hands, et cetera. And if you look to retracement levels, Fibonacci retracement levels, 3819 is one that we came very close to. That's a 38% reduction of the bull market move from 2020 to early 22. But then if you go to the next level, a 50% retracement, we're looking at a 3,500 on the S&P 500. You could also match that with valuations, because when you look to garden variety bear markets since World War II, they have essentially taken back about 35% of the PE ratio, meaning that the PE has gone from an average of 18 and change down to about 11 and change. So apply a 35% reduction to a PE of 23 times trailing 12-month earnings as we saw in the latter part of 21, that would imply that maybe 3,400 for the S&P 500 could be an ultimate bottom. So with that in mind, yeah, we probably do give back about 50% of this bull market move. It ends up being a weaker or shallower than expected bear market. And then, possibly what we find is that because of the effect of employment trends, the effect on the economy, that the Fed signals, you know what, maybe we don't have to be as aggressive as we had implied earlier, and that could end up triggering the bottom.
Right. Well, we're going to see. We'll see the way it plays off. But Sam, last fall we got to the most, I think, extreme period of time of growth over value. People, and I was writing in what I was trying to say and talking to clients. If you didn't hear the music getting faster and faster, if you didn't see some chairs being taken away, then you really didn't have the experience of the market. So we've been, probably more bearish than most, more cautious than most. In a minute, I want to actually introduce a new acronym. Everyone needs a new acronym, right? But frankly, here's the music I'm hearing. I know you're a music buff. The music I'm hearing in the market right now, and I'll age myself a little bit too. We hear raindrops keep falling on my head.
Yeah.
I can't get no satisfaction. And my city's in ruins. And
yeah, BJ Thomas and the Rolling Stones, they certainly were singing about things that could apply to the stock market, but go ahead.
But so the whole idea here is, Sam, what we got caught up. I remember when they oversold the BRICS. And the next thing you know, Brazil, Russia, India, China, they just got destroyed after people got into and fully embraced this concept of the BRICS. I think people who just cited the FANG stocks, these were great companies with great businesses, with great cash flow, and they went to extremes. And so bringing in some seasonal tactical things that you like to do, and I use my model, which basically brings me quantitatively. I've come up, Sam, with the acronym for this economy in this market. I call it the ouches. Okay, and what that is, it's oil and gas, it's utilities, it's commodities, it's healthcare, and it's shorting, frankly, the crazy high price to sales, unprofitable companies that just capture too much imagination. So I introduced for the first time to you the ouches, submitted for your approval. But I know that in all seriousness, some of these acronyms, some of the letters really match up to your tactical switching and defensive nature at this time of the seasons and even the presidential cycle.
Well, you're absolutely right. And I think acronyms are wonderful ways to remind us of what the talking points are. So the ouches, I think, are very good. And if I do leverage it, I will do so with attribution. But you're absolutely right that right now we're in a period where investors are worried about accelerating inflation. And if you look to the 12 recessions since 1948, which is as far back as we can get year-on-year data for headline CPI, we've also had a similar number of bear markets, and 9 of those bear markets were associated with recessions. And what I have found is that should this end up being similar to what happened in the past, that we probably have a deeper and a longer bear market than we traditionally would. So, 87 was a 33% decline. The 1961 bear market was in the 20% area, ditto for 1966. So, those tend to be fairly swift ripping off of the Band-Aid, something that spooked investors. In the early 1960s, it was President Kennedy's spat with U.S. Steel about steel looking to raise prices. 87, it was computer trading, et cetera. But if there's not an underlying erosion of support by the economy, then we tend to come out of it fairly quickly. So you're bringing up the point also with high inflation, investors tend to gravitate toward the more inflation hedge areas like energy, like materials. In the 1970s, we started the decade with a year on year read of 5.5% for headline CPI. We ended the decade at 12.5%. Not surprisingly, we ended up with only about a 1.5% compound annual growth rate in that decade. And we ended up having Paul Volcker strangle inflation by jacking up interest rates to close to 20%. So I don't think we're going to have that kind of an effect this time around, but we are looking at the year-on-year change in headline CPI that's approaching 2 standard deviations above the mean. So I don't think we're going to get out of this unscathed. So typically, we also find that besides the inflation hedges, it's the defensive areas. When the going gets tough, the tough go eating, smoking, and drinking. And if they overdo it, they have to go to the doctor. And so, and then, add to that utilities. So you've got consumer staples, healthcare, utilities, as you were just mentioning. These are the defensive areas where the demand for the products and services remains fairly static. They will decline in bear markets, in recessions. They just won't fall as much. And if you are looking for areas that have traditionally increased in price, it's only been tobacco and gold. So very few areas that have gone up in price in general. But I would tend to say, really, it's more a matter of not allowing your emotions to become your portfolio's worst enemy, and try to become opportunistic by buying those areas that have been beaten up so badly, in a sense, thrown out with the bathwater, and just realize that we go through these cycles all the time. So take advantage of it.
Right. Well, Sam, two things you gave us to chew on, difficult things, tobacco and gold. But let me just go to one last point here, as the historian, and something that I've seen and pointed out over the years, and these are not short-term charts. These are kind of what you alluded to, where you have periods where you have a full decade of high teens return. The next decade looks a whole lot different. And then you get to a period where you go a whole decade of almost no returns. People are demoralized. People want to avoid stocks at all turns. And then the next decade looks a whole lot different again. So I've seen these rolling 10-year return charts that basically last year said, if you hear the music getting loud and you see the chairs getting taken away, this next decade is going to be a whole lot different. So, have you seen those charts? Can you talk on those?
Absolutely. Very simply, all you need to do is to compute a rolling 10-year compound annual growth rate for the S&P, for the Dow, what have you.
Right.
But make sure you go back far enough. And what I have found is that we saw peaks in 1929, 1959, 1999, and here we are again at a peak where in earlier, in just about a year or so ago, we were looking at a year-on-year change of more than 14%. 10-year compound annual growth rate of more than 14%. 1 standard deviation above the mean is 11%. And the mean is somewhere closer to 7 or 8%.
Right.
So it doesn't mean that we are headed for a cliff. It's not like we are Wile E. Coyote and we look down and there's nothing to support us, but it just implies that we are now on the leeward side of this very inflated stock market bubble, and that the rolling 10-year returns will be coming down. That is, of course, if history repeats, and there's no guarantee, but
Correct.
I think it'd be pretty amazing if we ended up continuing with a double-digit CAGR for the market over the next several years. So yeah, prepare yourself for what worked in the last decade might not work in this decade. You brought up a good point. From 1956 to 1966, we had wonderful returns. Then we ended up with an 18-year secular bear market. And then you look to the 1990s were wonderful, but then the 2000s were the complete opposite. So take a look at the 10 best performing sub-industries in the end of the 1990s, and they were among the worst sub-industries in the 2000s. And then conversely, the 10 worst ended up being the 10 best.
Right. No, it's really super important to do and have the experience that you have and look back and not really get caught up in the last 2 years, what happened, and think it's going to continue. And then just lastly, Sam, I really do appreciate the fact that you're willing to use the word recession. You're willing to talk about the fact that the next several years, might be a different picture. A lot on Wall Street will say just ride out every storm. It eventually will come back, but I think you could be much more tactical. I think things are getting more epic, rather than, every car chase is faster. Every market seems to be more accelerated up and down. And what we're hearing is that the consumer is in great shape. The consumer is wonderful. The consumer is so rich. Sam, the top 5% of people never have to look at anything. Okay. But what I'm seeing is actually people taking on debt and the consumer being strangled a little bit by this inflation. And the consumer is probably not, in my opinion, from what I'm seeing, as healthy as what they really would like to say. It's showing up in retail sales. It's showing up in retailers' future expectations. So yeah, we could use the word recession. We don't have to be afraid of it. And we don't have to be afraid of bear markets either if you're prepared for them.
Right. Well, I think there are 2 points that you're bringing up. First is just look inwardly, like this old house would say, measure twice, cut once. And, that same goes for investors. Look inwardly to find out what kind of an investor you are. If you want to be proactive, well, in some ways, you've got to be right twice, knowing when to get out, knowing when to get back in. You also have to be right in terms of rotation versus retreating, et cetera. And so if you have some strategies or you have some advisors who are good at that, well, then go ahead and do it. If not, then I would say, don't let your emotions ruin your portfolio. Remember that the recovery time for corrections, meaning 10 to 20% declines, is an average of only 4 months, whereas correction times for garden variety bear markets, 20 to 40% declines, is 14 months. If you don't have 14 months, you shouldn't be invested in stocks. Remember that the bear market of 2020 got back to break even in under 5 months. So that's the first thought. But you're feeling also, the second point is that a lot of times early in a bull market, or a bear market, the declines in price are the result of PE contraction. As interest rates rise because the Fed is taking a more aggressive monetary stance, and we get closer to inverted yield curves, et cetera, yeah, we see a contraction in PE ratios because there is a negative correlation between PEs and rising 10-year yield. Then we have step 2, which is the reduction of earnings estimates. You were just talking about the consumers. The old saying is consumers stop spending when the banks stop lending. And, basically we got to wait until the banks say, wait a minute, I'm not really sure I think that you have the wherewithal to pay back this loan. And you are now looking to borrow money because interest rates are a lot higher and you can't pay for it out of pocket. So I think we have to be prepared that it's not over with the first pass. That's just the first half of the hurricane. Now we're in the eye. And then we say, okay, well, what's going to happen when the earnings estimates themselves start to come down? And that's when we see the concern that you're talking about, the moving chairs. I like to say that investors are no better than hyperactive first graders playing musical chairs, always trying to out anticipate the other as to when the music will stop. And so we're in that period now.
Right. Well, really well said, Sam. And I want to just, reinforce what you're saying. When you let your emotions guide your investment behavior, it's always a losing game. And for a lot of people who have the time, they really even need to sometimes double the allocation when things are really down and things feel really bad, because the sun does rise again. There are people calling for the end of the world this time. And we know if we eat right, Sam, and I see you're eating right, if we eat right and sleep right and get a little exercise, in a few years from now, we'll be talking about how good things are again and how, maybe we anticipate at the bottom. So I think all your points are right on, Sam. That's why we love to have you on, and the long-term perspective. So we'll wrap it up here. I can talk to you all day, frankly, but I know you have a lot going on. So it is Sam Stovall, Chief Investment Officer for CFRA. And Sam, you're the tops on the street, and let the music keep playing for you.
Thanks a lot, Jordan. I look forward to talking to you again soon.
Terrific. Great to have you. And folks, we'll wrap it up here. This has been Magnet Minutes for the Informed Investor.